This content is for educational purposes only and is not financial advice. Investing involves risk. Do your own research and consult a professional before investing. Hi everyone, welcome back to the channel. Actually, there is a fund I've been meaning to talk about for a while, which is Brompton's BMAX. As one of the earlier multi-asset income funds to hit the market, BMAX now has over 3 years of track record as we head into early 2026. As a former index investor, I used to benchmark almost every fund I analyzed against the S&P 500. When screening for my own portfolio, my initial impression of BMAX was simply that it lagged the broader market. However, after diving deep into its underlying architecture, I realized BMAX might be far better than I originally thought. Let's look at the basic spec of BMAX. Its full name is the Brompton Enhanced Multi-Asset Income ETF. Take note of two keywords here: enhanced and multi-asset. This tells you it isn't just a simple income fund, but a diversified powerhouse that utilizes leverage across multiple sectors. Launched in October 2022, its 3-year steady performance in this volatile high-yield market is enough for us to gauge its resilience and distribution stability. Currently, its AUM sits around 130 million Canadian dollars. While that isn't massive, it is backed by a veteran manager like Brompton, so you don't need to worry about liquidity. Regarding management fees, there is a detail I must highlight. BMAX charges 0 management fees at the ETF level. It only collects fees from its underlying assets. The current MER stands at 2.85%, which might seem high, but that is primarily due to the borrowing costs associated with its roughly 33% cash leverage. So what is actually inside BMAX? Simply put, it is a greatest hits collection, allocating capital across Brompton's top-performing sector ETFs. Geographically, it is anchored in North America at 79.5%, with 18.8% in Europe and a small portion in Asia, achieving true global diversification. The sector logic is very clear. The largest slice is 21.2% in fixed income, consisting of split corporation preferred shares and some CLOs, collateralized loan obligations. The rest is spread across growth sectors: 19.4% in financials, 14.7% in tech, 14.5% in healthcare, and 10.7% in industrials. The allocation is remarkably balanced. It doesn't overconcentrate in financials like HDIV, nor does it lean too heavily on tech like HYLD. With 20% in fixed income, the logic is to capture equity growth while maintaining a high margin of safety from preferred shares, essentially an 80-20 balanced portfolio. Currently, BMAX maintains a steady annual yield of around 10%, paying out monthly without fail. The secret to sustaining such a high yield lies in that 33% cash leverage. Think of it as using $1 of capital to put $1.33 of assets to work for you. While leverage is a double-edged sword, within this multi-asset framework, it acts more like a yield enhancer. For cash-flow-focused investors, this one-stop-shop solution is definitely worth a second look. Since BMAX uses an 80/20 equity-to-preferred share ratio, that leads us to two key points. First, regarding the structure, I actually chose the wrong benchmark before. You shouldn't pit a fund with a 21.2% fixed income allocation directly against the S&P 500 or the TSX 60. Even with 33% leverage, we must understand that in a covered call strategy, leverage is mainly there to compensate for the volatility and potential upside lost through the covered call strategy. Therefore, it is perfectly normal for an 80/20 mix to lag a pure equity index. The true benchmarks should be growth ETFs like VGRO or ZGRO, which maintain a similar 80/20 split. When compared side by side, you'll see the performance is quite similar. Since BMAX's inception, the total return, with dividends reinvested, is 73.82%, compared to VGRO's 75.37% and ZGRO's 77.07%. Considering GRO stands for growth, it is clear that a 20% fixed income allocation doesn't mean poor performance. Looking at its specific track record, it posted an 11.3% return in 2023, 19.5% in 2024, and maintained a high standard of 18% in 2025. The second point is the crucial stability of the NAV. For investors like us seeking passive income, NAV stability is our lifeline. For those relying on distribution for their living, significant NAV volatility often signals a risk of future distribution cuts. If a fund's NAV is constantly eroding, then even a high payout is essentially just returning your own principal. But BMAX's data is very encouraging. Even excluding dividends, the ETF's share price shows a steady upward trend. A rising NAV, in turn, supports sustainable distribution growth, creating a virtuous cycle. This stability is backed by a solid underlying allocation. The 20% fixed income base acts like a bulletproof vest for the NAV. Even if a specific sector fluctuates, the overall portfolio stays relatively steady. In fact, since its inception, BMAX hasn't cut its distribution once. Some might argue that a 3-year history isn't long enough, but while BMAX as a whole is 3 years old, its underlying ETFs like TLF, BFIN, BGIE have histories spanning over 5 years. Even during the brutal market shock of 2022, these underlying funds only paused distribution increases. They never decreased them. That kind of stability is rare for income-dependent investors. Furthermore, the 20% fixed income portion serves as a safety cushion. Because preferred shares have intrinsic value, their NAV tends to stay within a reasonable range. During a crash, they usually drop far less than common stocks, allowing the manager to rebalance, selling stable preferred shares to buy equities at low prices. This buy low sell high mechanism allows BMAX's NAV to recover much faster than pure equity funds. This is why I feel confident in the NAV level of BMAX. Many people compare BMAX with HDIF from Harvest. Let's do a quick comparison. BMAX's total return is 73.82%, while the total return of HDIF is 68.51%. HDIF it is 100% equity, but it still underperforms BMAX. Given the similar or slightly superior total return of BMAX, I would choose BMAX for that 20% fixed income cushion. Moving past the data, I want to share some personal reflections. Those who know me know that I have always been a staunch passive index investor. I am naturally skeptical of actively managed funds, especially those involving discretionary stock picking. However, BMAX's track record and its distribution stability through volatile markets have truly won me over. It is a testament to the expertise of the Brompton management team. In the Canadian high-yield market, Brompton isn't the flashiest player. Their covered call execution might not be as efficient as Evolve's, and they don't pump out new funds to attract capital as frequently as Harvest. But having watched BMAX for a long time, I believe it does exactly what an income fund is supposed to do: maintain its NAV while providing a stable, growing distribution. For retirees or those seeking steady long-term growth, this stability is far more important than any marketing gimmick. BMAX's configuration of sector diversification plus 20% fixed income cushion plus modest leverage is a very mature, one-stop solution. Its real value is that you don't have to stress daily about whether tech is overvalued or if financials will tank. It is just there, using its rebalancing mechanism to quietly generate monthly cash flow. This 80-20 structure gives me the peace of mind to hold through a turbulent market. To be honest, because I am currently in a career transition and need higher immediate yields to cover living expenses, I don't hold BMAX right now. But I've been thinking, once my financial situation becomes more comfortable and I no longer need to chase maximum turnover, BMAX will definitely be one of my must-buy holdings. Thank you for taking the time to listen to my thoughts. I'm Oldfish. If you found this helpful, please like, comment, or subscribe. I'll see you in the next one.